Okay, well, hello everyone. This is Dr. Sam Lanzafame again. This time we're going to be talking about Treasury stock. So hopefully you've got something to take notes with, and let's get started. Over to the left of the screen, I did some typing already here. Over here to the left, I've got a typical stockholders equity section. So I'm just going to highlight that a little bit so you can see what that looks like. And let's just put this in this color here. So you can see this is our information before any uh, dealings with this treasury stock topic that we're about to look at. And you can see here we got common stock, $2 par value. There's 300,000 shares authorized, 200,000 shares issued and outstanding. So this 400,000 that you see there, basically that's attained by taking the $2 par times what is actually outstanding. So 2 times the 200,000, that's where the 400,000 came from. Pick in excess of par or paid in capital in excess of par. If you remember from a previous discussion, that is whenever stock was issued or sold above par. This is the account that actually helped track that information. And then you've got your retained earnings. So altogether, we've got $700,000 worth of equity. So before we get into the example, let's take a look over here to the right side of the screen under column K through Q. You'll notice that I have a little definition. Treasury stock is used when a company buys back its own stock. So reasons for something like this, a company might be worried about a hostile takeover, or maybe they're trying to make their stock a little bit more attractive and they may take it off the market. Maybe people may want it more. But usually there are a lot of different reasons, but those are probably the top two reasons why companies will take their stock off the market. Probably because they don't want anyone else to buy too much of it and then have a controlling interest in the company. So sometimes they need to kind of play defense a little bit. So what I'd like to do is create two accounts. One's going to be called Treasury Stock. I'll just abbreviate it as T Stock. Okay, and then I'm going to create its buddy account or sidekick account. And we've seen a lot of sidekicks throughout these videos. The very first one you saw was a contra asset called accumulated depreciation, that contra equipment or a building. Then we were looking at sales returns and sales discounts as contra revenues to sales. We've seen allowance for doubtful accounts, AFDA, which was a contra to accounts receivable. So we've seen a lot of sidekick accounts, and most of the time they were contras. This one is a little unique, so we're going to call it pick from treasury stock transactions or pick from T stocks. And again, I want you to think of this as a uh, kind of a buddy account, but it is technically a contra. All right. So a couple of things I want to point out to you here is that the treasury stock is a contra equity in itself. So remember we talked about liquor accounts, liabilities, capital, common stock, retained earnings, revenue. These are all liquor accounts. They carry credit balances. Well, T stock, treasury stock, is an equity account, but it makes your equity section go down. So technically, treasury stock is a contra equity account. So it goes up by a debit and decreases by a credit. So keep that in mind as we go forward. Another thing to think about is this pick from T stocks. It's the contra to the contra, which is kind of strange to hear, but this actually works like a normal equity account. So you'll notice that it increases on the credit side and decreases on the debit side. One little rule about pick from T stocks, you are allowed to debit it, but it can never ever have a debit balance. So let's put that in here. So we're allowed to debit this account, but it can never have a debit balance. So please keep that in mind. All right. If for some reason we feel compelled to debit it for more than what the balance is there, we make up the difference with an account called retained earnings. So we'll just put that in here too. And it may not mean too much to you right now, but when we do an example, I'll show you what I mean. Okay, so we've got our two main accounts that are brand new to this lesson, and we've got the Treasury Stock account, and then we got its contra PIK from Treasury Stocks. Now, the last time you saw PIK in the previous video, it was called PIK in excess of par. We're not dealing with par value when we're dealing with this PIK account. So just keep that in mind. So the par value is actually pretty irrelevant to this discussion. Okay, so let's take a look at the left side of the screen again, where I have here assume. It says assume the corporation buys back 3,000 shares of its stock for $5 a share. This is the current market price of the stock. So it doesn't matter what the par value is. When the company buys back its own stock, it's based on what the current value, what the current market price is of that stock. I like to personally call this the pivot value. That's just my own little lingo that I like to use. If you've ever played basketball or seen people play, you know when they pick up their dribble, they can't continue to move, so they can only pivot on one foot. They can go left, they can go right. So think of this as like we can go up or we can go down from this pivot. So we're going to use the pivot value is going to act like the par value in essence, but we can't call it par. So we'll just call it a pivot, or if you want to just go back and use the original market price of that stock when we bought it, you know, at this on this particular date, then that's cool. Okay, so if we go and want to do this journal entry, right, we want to buy back 3,000 shares. So remember, Treasury Stock is an equity account, but it works as a contra. So the first move is always a positive. So we're going to debit Treasury Stock and we're going to credit. Any idea? If you said cash, you're right. So we're going to debit Treasury Stock, we're going to credit cash, and basically we're going to do it for 3,000 times the 5. So that's going to be $15,000. We got 3,000 shares, and we're buying it back at the current market price of $5 a share. So let's just put that in here. 3,000 shares times $5 per share. So that's the journal entry. Debit Treasury Stock, credit cash. If I said bought equipment, you'd debit equipment. If I said bought supplies, you'd debit supplies. Here we're basically buying back our own stock. So we're debiting Treasury Stock. So remember, Treasury Stock makes your equity go down. So remember the stockholders' equity section we had up here? 400,000, 100,000, 200,000, 700,000. Well, now let's see what that looks like after. So let me change this to after. So after the Treasury Stock transaction, notice I still have common stock, $2 par, 300,000 shares authorized, 2,000 shares issued and outstanding. There's 400,000, there's 100, there's 200, total is 700. But notice now I am subtracting the Treasury stock. So notice the stockholders' equity section is now 685,000 as opposed to the 700,000 that we had before. So Treasury stock makes your stockholders' equity decrease. I just wanted to show you that just so you would know how it would look in the stockholders' equity section. We won't do any more with the stockholders' equity, but I just wanted to show you. Okay, so let's focus on the Treasury stock here. So keep in mind that we started with $15,000 in this account. Okay, and we credited cash. I won't bother using that T account, but I just want to remind you of that. So let's continue on a little bit here. Let's move these down to right about here. Okay, and let's put that 15,000 back in there. Okay, this way we don't have to scroll up and down so much. So look at the next transaction here, right over here. I'll put assume again. And it says assume the corporation sells back 1,000 shares of its treasury stock. So remember, we bought it at that pivot value of $5 a share. Okay, so that's kind of like our benchmark that we're trying to, when we reissue these to the market, we want to issue them at higher than 5, so we kind of make a little money off of it. Right? But sometimes, the stock market might be kind of fickle, as we know, and the stock value might be plummeting. And even though we're losing money, we might just want to cut our losses. So sometimes you may end up reissuing these at a lower amount than the pivot. Okay, so let's pretend that the price of the stock is doing pretty good. We don't anticipate it going any higher, and we decide to reissue 1,000 shares of our treasury stock, and the current value is $8 a share. Okay, so what we're going to do is we're going to debit cash because we're literally selling it back. So let's do the math in here. So we're going to go 1,000 shares, and we're going to multiply that by the 8. So that's going to be $8,000. We have to remove the treasury stock from the books. And the treasury stock's got to come, it went on to the books at the pivot value. It's got to come off the books at the pivot value. So I'll just use T stock again, kind of like that abbreviation. So these same 1,000 shares are now going to come off the books at the original pivot of $5 per share. So that would be $5,000. So notice our debits don't equal our credits, so that's where the PIK account comes in. So we're going to credit PIK from treasury stock transactions, how about PIK from T stocks, and that's going to be the difference, which would be 1,000 times 3, right? The difference between $8 and $5, and we'll put that 3,000 in here. Okay, let's put this in a different color. So if I were to go post this information, if I go and credit my treasury stock for 5,000, this account currently has a debit balance of 10,000. 15 minus the 5. And I also want to credit my PIK from T stocks, and that currently has a $3,000 credit balance, and that's normal. PIK from T stocks should always carry a credit balance. It's okay for me to debit it, but in this particular scenario, the most I will be allowed to debit it for is for 3,000, because PIK from T stocks can never have a debit balance. I'm allowed to debit it, but I can't debit it for more than 3 in this example. So if for some reason in the next scenario I'm 4,000 short, I can only debit the PIK for 3, and then I would use retained earnings for the extra 1,000. That's what I was referring to up here. So I'm allowed to debit this account, but it can never have a debit balance. So to make up the difference, I would use retained earnings. So I created 2 scenarios. Okay, so let's take a look at the next scenario here. So we're continuing along our example. So this one says, let's assume the corporation sells the remaining shares of T stock for $4 a share. Okay, so we're going to debit cash, and we're going to go 2,000 shares, at $4 a share. Let's see if this works out right. We may have to change it a little bit here. So 2,000 times 4, oh, I'm sorry. Yeah, 2,000 times 4, that's going to be 8,000. I'm going to skip the pick for a second, and let's just go to T stocks. So we're going to credit T stock. Remember, the Treasury stock's going to come off the books the way it went onto the books. So the 2,000 shares are going to come off at $5 a share. So 2,000 times 5 is 10,000. So notice that right now my debits don't equal my credits. In order to get this thing to work, I've got to debit something for 2,000. And that something would be my PIK account. Question is, am I allowed to debit PIK for 2,000? And if you look at our T account over here, we had a $3,000 credit cushion. So I'm okay by debiting the PIK for 2. If this had come out to 4, then the most I'd be able to debit it for would be 3. So I'm okay to debit PIK from T stocks, and that would be the 2,000 shares, and it would be at the difference, which is the dollar per share. Okay, so let's just look at it from a different perspective. All right, so let's say, so let me actually, before I do that, let's change this color to green or something. Might be helpful if I highlight the whole thing. It doesn't look like green to me. Let's make it a little bit more obvious. There we go. Okay, so if I were to post that information, let's just make sure you can follow along here. If I debit the PIK from T-Stocks, you'll notice that it still would have a credit balance of $1,000 because my credit side is bigger than my debit side. So 3,000 minus the 2 gives me 1,000. So I'm okay. And if I were to credit the Treasury stock for the 10, you'll see that it completely goes away, leaving us with a zero balance in the account. Okay, so that looks pretty normal. So now let's see what happens if we sell the remaining 2,000 shares for only $2 a share. So let's go back to here, copy this, put that down here. Put this 15 back in there, and let's put this 3,000 back in there. Oops. There we go. Okay, so again, I have this $3,000 cushion that was created from this blue transaction, right? And let's not forget, we also had another blue in here, which was the 5,000. Okay. Alrighty, so now let's pretend this green one never happened, the one on the left. And now let's go back and say, all right, we sold the remaining 2,000 shares for $2. So now this is going to be a completely different situation because if we go and do this, what's going to happen is you're going to realize that our pick from T-stocks, we don't have enough in there. So let's kind of take it slow. We're still debiting cash, and the amount of cash is 2,000 shares, and we're going to multiply the 2,000 shares times the $2 per share. So 2,000 times 2, that's $4,000. Okay. Let me jump to the T stock because I know those are coming off the books because I'm selling the remaining 2,000 shares. and those are coming off the books at the original pivot. Remember that? So that's the $5 per share. So if I go 2,000 times 5, that's 10,000. So that's the same credit I had in this transaction because they got to come off the books at what they came onto the books as. So now notice that I have a gap between my debit and my credit. I am $6,000 short. Dun, dun, dun. Houston, we have a problem. And the problem is, remember, here's my pick from T-Stocks. I only have a $3,000 cushion in that account. I am not allowed to debit it for 6 if it only has 3,000 on the credit side. So I'll empty it. I will debit the pick from T-Stocks for the maximum that's in there, which is the 3,000. So I've completely emptied my pick from T-Stock. So the cushion is gone. It's down to 0 now. So let's just prove that here. So if I put 3,000 in there, notice now it has a 0 balance. 3 minus 3. Okay. If it had a debit balance, I would be wrong. I would have made a mistake. So now in order to get my debits to equal my credits, I've got 7,000 on the debit side, 10,000 on the credit side. I need another 3,000 to make this thing work, right? So 3 plus 3 is 6, plus 4 is 10, and that'll equal the 10. So now I'm going to make up that difference with retained earnings. Okay, and that's how you handle treasury stock transactions. Hope you found this to be interesting. Hope you found it to be informative. Remember, you guys probably have an accounting textbook with this material in it as well. So look at the chapter. You probably paid good money for your accounting book. So there's only probably 2 or 3 pages dedicated to this topic in the chapter that's associated with your textbook. So go back, look at the examples that they have, and if you get stuck, maybe go back and rewatch this video. All right, this was Dr. Sam Lanzafami again. I hope we'll see you for the next video. Plan on talking about small and large stock dividends. So that should be pretty interesting. All right, have a great day. Bye-bye.